Everybody, welcome to Friday and another Talk Money with Tom show today. Really excited that you could join us. This is a question and answer show. You can send in your questions to Ask Tom at talkmoneywithtom.com. And we have now enabled chat actually. So if you decide that you just want to sign into your YouTube account, you can put your questions into the chat box as far as that goes also. So really excited. As if you've watched this before, you realize that our big focus is on retirement, and you can be 20 or 80, and retirement is still one of the biggest financial goals that you might have, and obviously one of the most gratifying if done correctly. So if you're already retired, learning about making sure you don't run out of money and how to manage the money, the assets themselves is spectacular. And obviously, if you're not retired, the three main areas that we focus on with retirement planning and money management and tax management are, I think, very appropriate. So we believe that this knowledge helps you have a better retirement, and that's why we do this show as far as that goes. And so I want to thank everybody that has sent in questions already. These shows have been really fun for us as a whole. We do continue to post on this channel all kinds of, I think, educational content that would help you get from where you are to where you want to go. And so if you want to see that on a constant basis, you can subscribe to the channel, hit the little like button, or just send us your email and we'll put you on our email list as far as that goes. So really looking forward to today's show, and I look forward to being able to answer your questions. I like to start off the show with just a summary of what I saw happen this week in the market. One of the biggest things that we do as heading into retirement or in retirement is managing the money that we have. Eventually, once you retire, you're going to be living off of these assets, so making sure that they have the proper structure and can grow and such is really important. So there's several really big things that happened actually that I thought were fascinating this week. First of all, on Monday, we started to see a big downturn caused by a company called Evergrande in China. And so a couple things happening there. This is a big real estate company. They have 300 billion in debt. And there was a lot of concerns because of the size of the debt. They have an $85 billion of that debt that was coming due. So normally that's just bonds coming due. They'd issue new bonds. Well, because of the high leverage and the situation in China is a little bit unsteady right now. The regulators are coming into lots of these different businesses, and so outside capital is being a little bit cautious about coming into China also. So there were some question marks of whether they were going to be able to, reissue new bonds and make this payoff. And so some of that was resolved, and hearing a little bit more news now that maybe some of it isn't resolved. But personally, I don't think that's going to be a huge problem. We'll see what happens there. But a lot of people were thinking about Lehman Brothers, which had a $150 billion bailout that they were talking about doing, that they didn't do, and it ended up cascading into, what happened in 2008 downturn. So that's the fear that's happening there. But this is also a centralized control government and trying to become more so. So I do think that there's enough money there to kind of handle some of these situations, but it's something to definitely watch for. But then on Wednesday, we had the Federal Reserve meeting. And this was very fascinating because they said things that I hadn't heard really ever before. Number one, they're talking about raising interest rates in 2022, and that they might have 6 to 7 interest rate increases by 2024. So that has not been talked about before. In the past, it was always about raising interest rates in 2023. And so that was new. They also talked about cutting back on the bond purchases. And some of the wording that they talked about was that they might have to cut back on those bond purchases faster, depending on what happens. So the market responded quite nicely to this, especially yesterday. We had a really big upward movement. And so it seemed to find those comments in a positive light, which was interesting to me because all the way through this year, including all the way up to this summer, whenever they started talking about raising rates faster, cutting back on the bonds quicker, there was a lot of softness in the market around those comments. And to see a very strong upward movement, I thought was kind of interesting. But part of that reasoning may be because there's a bunch of investors that are worried about inflation, and they're worried that the Federal Reserve isn't going to respond fast enough, that they're going to continue to buy bonds for too long, and or not raise rates fast enough to contain the inflationary threat. So, this is going to be walking a tight wire for the Federal Reserve. It's going to be really interesting to see how this plays out as far as that goes. So that'll be an ongoing story. We'll know more here after the next meeting, that's for sure. So the other story I think is probably the most important, at least in my opinion, and that's the raising of the debt ceiling. Going back to 1870, they decided that the Treasury Secretary had to come to Congress and ask for the debt ceiling to be increased. And then they basically can continue to issue new debt, which is what we do to kind of pay our bills and pay off old debts and what have you. And so we're going to hit this ceiling here at some point here in October, it looks like. And essentially, it's now become sort of this big political football, which I really don't like to talk a lot about politics on this show or on my videos, just because I have clients across the entire spectrum and I don't want to offend anybody. But this is one place where politics is really intersecting very heavily with the stock market. If they don't raise the debt ceiling and we were actually to default, which has never happened, but if that did happen, it would be pretty cataclysmic. So it's a big deal. So the House passed a package that would increase the debt ceiling. It's gone off to the Senate. Nothing's happened in the Senate yet. My thought process is they're going to try to run it through the Senate to try to make the Republican side vote no, so that they can use that as ammunition in the midterms. And then the Democrats have actually two different ways to raise the debt ceilings on their own. One of which is this reconciliation package that they're working on, this $3.5 trillion package you keep hearing about, and who knows what dollar amount it'll actually be in the end. They could add a debt ceiling increase to that package and pass it with just a simple majority, with the 50 votes that they theoretically have. The problem with that is that package is so large and quite contentious even within the Democratic side that there might not be enough time to get that package through in time to, not have a default on some of the debt that we have. So the other way, I think, is probably the more ideal scenario, and we'll see what happens, and that is that they can change the filibuster rules inside of the Senate. So technically right now you need 60 votes to basically get things through the Senate. And so they can use this filibuster to create that. But if they change those rules so that it's just a simple majority that needs, and they've done that twice before. They did it once for federal judges. So right now you only need 50 votes to get through a judge. And they also did it again for the Supreme Court judges. And so again, you only need 50 votes to get that through, to get a Supreme Court justice in place. So they could change the filibuster rules again, just identifying the debt ceiling as an exception to that. And so they could then say, all right, this is a majority vote. We only need 50. And then they'd run that vote through, get the 50 votes, and raise the debt ceiling. Or in my opinion, even better yet, why don't they just get rid of the whole concept altogether? Because when you ask basically the Treasury Secretary to come into Congress, it used to be it wasn't a problem, but now it's become this big political thing. And the market movement that would happen from that isn't something that interests me. So I hope they get rid of it. But that is a very, very valid solution, is to amend the filibuster for that. So that's what's going on right there. Now, one of the other things that we're seeing here, right after the announcement from the Federal Reserve, is that the 10-year Treasury yield is starting to come up. It's up about 1.42% now. And so we're starting to see that move upward also. That has all kinds of different impacts on the stock market. So we'll have to wait and see what happens. Generally speaking, when you're seeing interest rates moving up like that, the growth stocks, the tech stocks, and those types of things will slow down, and the value type stocks will do better. So, we'll have to watch and see how that plays out. But that's an interesting piece of what's happened since the Federal Reserve, made their announcements in their speech as far as that goes. So, altogether, if you look at last Friday's, Positive Friday pieces, you can see, the market has been doing incredibly well for a reason. There's a whole bunch of positive pieces that are underpinning this, and those are still there. This downturn so far, at least, has only been 3.6% from high to low. And so that's not too terrible for the month. And then we've got this scenario where, the market fell through the 50-day moving average and then got back above it again. So, we're barely holding that 50-day moving average right now as we speak. And that will be somewhat important to see what happens, because there are a lot of people that trade on these technical pieces also. So very fascinating time frame. I think that this is an okay piece. I'd like to see the debt ceiling resolved. resolved. Other than that, everything else I think is fine. These downturns help to release the pressure of a continuation of an upturn that could get too expensive. So, let's see what happens. And I look forward to talking to you about it again next week. All right, Ethan, let's get into the question and answer session of this. I know that we've already gotten some from some clients and what have you too, so fire away. By the way, this is Ethan, who I missed identifying earlier. He's one of our advisors. He'll be the moderator today. When your questions come in, and he's monitoring the chat also, if you want to put it in on chat, then, he'll bring them up and ask me the question. I'll generally answer it. He'll come up with some other pieces of that, or maybe some other follow-up questions also too. So looks forward to doing this. What do we have first here, Ethan?
So the first question is about some news that came out of China this morning, how they're essentially cracking down on cryptocurrencies and ban or looking to outlaw their transactions. So do you think this, if like cryptocurrencies fail, will there be a ripple effect throughout the rest of the markets?
Yeah. You know what? Actually, a couple things. First of all, I do think it's a fairly big deal. The second biggest economy in the world is not allowing people to use cryptocurrencies for transactions. And it's one of the biggest problems with cryptocurrencies long term is just what they call the use case. What are you going to use it for? So you have this Bitcoin and, how do you use it? Can you buy things with it and what have you? So, but it is interesting that it's only down about 5% today. You would expect possibly that it could be down more because of what China's done. And I guess if I was a cryptocurrency investor, I'd be wondering, okay, China's going to do this. Does the US do it? Do other countries do it also? And that could be a really detrimental aspect to cryptocurrency itself. How that impacts the stock market is really kind of interesting. Uh, a couple of things. If somebody has to sell their stock holdings to cover some losses on cryptocurrency, that's how we get that contagion. So, for example, in 2008, when Lehman Brothers failed, there were all of these, mortgage bonds that were sitting out there that started to implode in that same time frame, and people had put insurance policies on top of those mortgage bonds, and they had to pay off. And so these are huge institutions. There was $7 trillion worth of these, they're called credit default swaps out there. So they had to sell, Cisco and IBM and such to pay off these credit default swaps. And so that's where you can get this connection, even though you didn't have, bonds in your portfolio, subprime loans, they were called at the time. You might still end up with some pain because people had to sell that. We have not seen that with this cryptocurrency so far. And I believe partly it's because there isn't tremendous amount of institutional buying inside of cryptocurrency. It's a lot of individuals. And although they might use leverage, they're not going to maybe have as big an impact on having to sell off for the stock market. I would suspect actually it could be positive because one of the things that has happened is those individual investors last year were mostly buying, technology, genomics, clean energy, right? All of these things. And then this year they moved a big chunk of their money off into the cryptocurrency arena. And so if that cryptocurrency starts to really falter, maybe some of that money comes back into the stock market. So I think it has a potential, at least in this environment, to be positive. And, we're seeing a decent market today. I'm looking at this. The S&P 500 is up 0.06%, even though China has done what they did. So it hasn't translated to stock market downturns, at least immediately. And I'd be surprised if it did, personally. But it's a great question. You should always try to connect the dots between different types of asset classes. So, because even if you don't have that asset class, what you do own could be the source of funds that somebody uses to pay off something that happens somewhere else. And so, and it's a great question as far as that goes.
Yeah, and with China, there's a lot of speculation that the reason they're doing this is more control, essentially shifting people to a digital yuan, which they have essentially ability to track
Yep.
rather
Yep.
than having this kind of cryptocurrency things.
Yeah, they talked about they were going to bring out the digital one and what have you. And so, they would make sense in competitive environment where they can control like they can and say, hey, that you can't use Bitcoin and or Dogecoin or whatever. There's 8,000 some odd different cryptocurrencies now for transactions, but you can use the digital yuan. And the U.S. has been talking about the digital dollar. That's come up a couple of times, especially this summer. And so, do they do something similar? So that would be my concern as a cryptocurrency investor. Yeah, it's a good point, actually. I think it's partly a competitive situation. I've said that a long time ago. It's one of the big problems. You're going to end up competing against these countries and their regulators, and they can change the rules on cryptocurrency basically overnight, which is what's happened right now in China. So not a big surprise.
Yeah, and so our next question is, a question that came up in one of our reviews this week, in a sense that how do I make my estate last for my children and my grandchildren?
Yeah. So this is kind of interesting. It's something that hits home. I've been doing this for 35 years. I've had lots of clients over the years pass away. I've been able to see what happens when the money gets distributed to the children. And for the most part, it's pretty good, but not always. I've seen some really crazy scenarios. And statistically, we've all heard the stat that 4 out of 5 people have been spent their inheritance within 5 years, right? And so, what this question is about is how do I make that not happen? If I end up with giving my kids this estate, how do I make sure that there's still something there for them even later, and they don't end up spending it all, or even hey, something for my grandchildren, the next generation also. And so that's I think a really fascinating concept because um, a lot of times the clients that I have, their kids are professionals. They're making good money and what have you. And so there's not a big fear of them getting this big lump sum. But you never know what's going to happen when somebody gets a big amount of money. Sometimes, some people kind of get into a spending mode that they weren't in before and they end up spending right through that money. So one of the ways to do that, and this is something I know I've done, which is essentially you set up a trust where all the money goes into that trust, and instead of getting a lump sum, they get an income out of that trust. And it doesn't have to be everything. You can have some portion go in, and so you set up a certain amount of withdrawal. Let's say a 3% withdrawal. You identify a trustee, somebody's going to continue to manage that long term, and there's lots of different options there as far as that goes, and they get money out of that trust every year. And my thought process with my kids is just simply that I just want to make sure that every year there's more money coming. That way if they blow it one year and blow it the next year, maybe eventually they get financially responsible and they start to use it properly and save it, invest it, or whatever they might do as far as that goes. And so there's all kinds of different ways of structuring those. But most people don't do that. I mean, most people just have a trust where the entire thing passes through as a lump sum and it isn't an income that goes out. But if that is a concern and you're trying to make sure that somebody has an income for life. You can use annuities also. I'm not as big a fan of those for a variety of reasons, but that's another alternative. But one thing to use potentially is a trust. You just have to structure it right. And a portion or all of your assets at your demise or goes into that trust, and that trust continues to live. And it could pay your kids, and then it could go on to pay your grandkids, assuming there was money left in it as far as that goes, which is why you want to have a pretty small withdrawal. Just for the chance that it might be able to continue to be there long term. So that's how I would address that. But it's a great question. It's not easy to do.
Yeah, and with trust, there's also they in California at least they only last for 90 years.
Yeah.
So essentially, you if you wanted it, you could maybe get to your great grandchildren,
Right.
but any further is kind of pushing it.
Yeah, that would be fine with me, honestly. I mean, if I could have an impact that long down, that would be awesome. I would be really excited. I think the bigger challenge actually is just making the trust last. Somebody's got to manage it. Those are the hassles that you have with the trust, and not blow it on investing and what have you, because you've got this withdrawal going on, and so yeah, there is lots of different parameters there to take a look at.
Yeah. So our next question is another topic you mentioned today in your weekly review. is interest rates. Should I be looking to refinance my house? And like, what kind of differential should I be looking for when I do refinance a house?
Yep. Yeah, we actually we've been getting some calls from clients just recently asking that exact question, which is, is now a good time to refinance? And my answer is definitively yes. When you see the 10-year treasury start to go up, it's been going up fairly aggressively this week. You will eventually see mortgage rates go up. Uh, I did a search this morning, actually, even for myself. I use bankrate.com, for example, just to see what's out there. It'll give you some quotes, and you're looking at around 2.5%. So the question is, should I refinance at if I can get 2.5%? A lot of times you can't get the best rates. They always come up with some things that you have done just not perfectly, and they try to make you pay a little higher rate. But nonetheless, um, it's a pretty easy calculation in the sense of two things. You can have one loan that has no points and no fees. So if you're paying 4% and you can get 2.5% with no point, no fees, that that obviously works as far as that goes. The other part that is with points and fees, and so fees most people are familiar with. You have title and escrow fees and closing fees and all these things. It's amazing how many people reach into these refinancings and grab a little bit of money at a time. So sometimes those can be passed on to you, usually for a lower rate in that case. Or you can have points, which is where you're paying a lump sum up front, again, usually for a lower rate. When you look at those, and let's say you have $10,000 worth of points and fees that you'd have to pay, you can look at a break even. So if you're saving, $500 a month, you're going to get that back in 20 months because, it's $10,000. And if you keep that loan for, 60 months or something, then, you've made money on it. That works. The real problem is if it's going to take 20 months to break even and you refinance it again 12 months later, then you probably were better off not paying the points and fees, because you didn't get that break even point. So that's important. But I guess the other thing for me personally, it has to be low enough to go through the hassle. I hate doing the refinance personally. They always have this process where you go through all of these questions and provide all this information, and then it goes to the final underwriters, and they basically start all over again, ask me for a lot of the same information. It's like they never met me before. It's frustrating. And so, I've done it a few times, but I'm looking at it myself right now because this is a really low point right now. And I feel that when the Federal Reserve starts to cut back on these bond purchases, so they're buying $120 billion worth of bonds a month. That's providing liquidity to the bond market. When they start cutting that back, you'll start to see interest rates come up, which is exactly what happened since Wednesday when they talked about cutting back on those bond purchases. And so as they actually start to do that, you're going to see rates go up and up and up. And all of a sudden that 2.5% mortgage is going to be 4 or 5 or whatever it might go to. There usually is a lag one way or another. And one of the things that's happening right now to kind of drive those mortgage rates down is that home sales are mitigating a little bit, and so they're having to lower the rates to try to get more people to take on these refinances and what have you. So yeah, I think it's a great time. I think you have to be really careful that you don't wait too long here because you might miss out on, you can get a 30-year loan at 2.5%. That's pretty amazing, actually. I remember my first loan when I built this house was around 8, and I thought it was a great deal. So, things change. So that would be pretty incredible to lock that in.
So, do you have any recommendations on like how to shop for a refinance? Like, how many banks should I check out? Like, are there any like kind of the banks that I should check out first, rather than like should I be looking at credit unions versus like your big banks like Bank of America?
Yeah, not exactly my area of expertise, just from personal experience, and then dealing with clients and their experiences. But one place to start is the place that currently has your mortgage. You never know; they might be able to do something at a fairly quick pace. So that's one place to start. Um, I like to kind of put it out, just look on the internet. I think the last two refinances I did were through Lending Tree, and there's a lot of those kind of services. I was pretty happy with that actually because they essentially shop it out. I just was on bankrate.com today or last night actually, and it showed all the different banks and all of the rates, points, fees, and the what they call the APR, which is the total rate that you would pay over the course of the loan. And interestingly enough, it had the number one bank in that listing happens to be the bank that I have my mortgage at now. So, I'm definitely going to give them a call and see what happens. I'm not going to hold my breath there, because they're actually going to take a pay cut to do that. But yeah, if I refinance it with somebody else, they lose it altogether. So you never know. But there are a whole bunch of different sources out there to take a look at, and I wouldn't discount using a mortgage broker. I know it's not used as much anymore, but they're pretty good about helping you get through the whole process. And so that's another alternative. But yeah, I don't have any real strong allegiance towards one way or another personally. It is interesting.
So our next question is on Monday, the build back better infrastructure build was is supposed to get passed based on the House would say the 27th is their deadline. Should I be looking to invest in infrastructure to take advantage of this bill?
Yeah, I think a couple things. You got to be a little careful investing in something that might happen on a political basis because you're right. They put a line in the sand, so to speak, that they wanted the infrastructure bill passed by the 27th, which is Monday. And but they're trying to attach it to the reconciliation package, and I've actually heard a lot of rumors saying that there aren't enough votes to get the infrastructure package passed on the 27th because there aren't enough votes to get through the reconciliation package. So always, when you're dealing with the government, especially Congress, keep that in mind because just it's hard to tell what's going to happen. There are some really great infrastructure. ETFs, exchange traded funds. And one that we have used in the past is a company called BlackRock, which is one of the largest money managers in the world. And they have a grouping of ETFs called iShares. And they have the iShares Infrastructure ETF. And the ticker symbol is IFRA, for example. So we've had that in our portfolios in the past. I think it's a pretty decent way of playing it. It's got a nice broad exposure, but there are specific exchange traded funds. I have no problem with going into those types of things. But one of the things I will say about the market this year, especially since mid February, it has been just rotating around from one thing to another so fast. Infrastructure is hot, but it's only hot for a week or a month, or whereas last year things ran really long. I mean, 6, 12, 18 months we had some trends that were going. And this year the trends have been so short that unless you're a day trader and a good one, who knows what's going to happen, you're really not benefiting by very much. And just buying the entire S&P 500 or buying the entire stock market, like the Vanguard Total Stock Market Index, for example. Actually, that's what we're doing now because of the fact that the trends aren't happening. Because what will happen is when they pass that infrastructure bill, I suspect there'll be a pop in the overall market, and you might make more pop in that infrastructure piece. But this year, you can't guarantee that that trend's going to last for very long. The other issue about infrastructure, in terms of buying in on a trend, is that that bill is an 8-year payout bill. And so those companies are not going to get the money on Monday. So it's going to take a long time for that to come through to earnings. And that's another whole nother process is who's actually going to get the money. And that is why I like to buy a whole basket, the exchange traded funds, you buy a whole bunch of different stocks that fit in those categories. And infrastructure as a whole, even globally, is a great investment. But at this point in time, honestly, I would be looking at just what's going on in the total stock market, being well invested there so that when those packages do pass, and they will pass at some point, in my opinion, then you would probably see a really nice, return come out of that whole stock market and not have to guess that it's going to come through this group of companies because that isn't working very well this year.
Cool. So we're going to a planning question now. So why do you solve to 85% of successful versus 99% for a financial plan? You know, shouldn't I always be at that 99% success rate every time for my financial plan?
Yeah, what Easton's talking about is what's called the probability of success that comes out of Monte Carlo simulation. So when we run Monte Carlo simulation, it'll run through the plan 1,000 times. It lets the computer randomly choose, amongst these different variables, and it tells you out of that 1,000, how many times did it work? The program we use doesn't go to 1,000 out of 1,000 for whatever reason. So 990 or 99% is the highest that it will go. And so, obviously, if you're at 99%, you're in a really, really strong position. It's looking at all of your outflows that you're spending, to finance your life. It's looking at all of your assets and then all of your incomes that are coming in from outside sources like Social Security or rents and all those things. And so it runs through your life 1,000 times, and you make it basically every single time. You don't run out of money, so that's pretty powerful. Um, but oftentimes, what I like to do is also take a look at where it would be at 85%. And what I'm trying to show people, number one is 85% probability of success is incredibly high. Your chances of running out of money are really, really low, and you still have chance to make adjustments, especially if you take a look at it every 6 months like we like to do. And so in that environment, I want to see how much more money somebody can spend, and just give them some budget. So let's say somebody said, well, I'm going to spend 70,000, and say, great. That comes out to 99% probability of success. We figure out the taxes, the medical, all of these different things, still at 99%. But if I run it back to 85% and just increase that 70,000, maybe I can get it to 100,000 and it'll drop back. And so all I'm doing there is I'm trying to show people, look, you could spend, if you needed to or wanted to, 30,000 more a year. Maybe you decide you want to take, bigger trips or whatever. So I think that is useful. I believe in the overall concept of retirement, of just having some bounds on what you can spend and then figure it out from there. So, whatever that bound is, I say, okay, for all the things that I have and the age that I am now, um, how much can I spend? So you can figure out what's the max and still keep it at 99% and then go back to 85. And so it does give you some range to figure out, hey, first of all, you could be wrong on what you think you're going to spend. You could spend more. So it's nice to know how much more you do have to spend. Or you may decide that you want to do some different things. And it'll give you some peace of mind of knowing that that's possible. Things change. You have to kind of run that Monte Carlo simulation every 6 months, in my opinion, to make sure that as those things change, you're not getting back into the 75 or 55% range. But it does give you a good basis for what you can spend in total, in my opinion.
Yeah, and so like if the market has a good run like we did last year, your percentage could the money that you could spend could go up. And so, you know, having that ability to say, hey, my portfolio went up 500,000 because it just we had an amazing year. Could I, spend that extra 50K on a special trip?
Yep.
That's like definitely you could do that when you have that ability to check that plan just to
Yep.
know.
Yep. Yeah. No, it's really cool. I mean, you know, you have to be willing to go the other way. You have to be willing to cut back if you lose 500,000, and so that's important to understand. But also the ability to reward yourself once in a while. When you have an outsized returns on the upside. Is I think it's awesome. And we try to achieve that every year, obviously, but it's not always that easy. But anyway, that's a good point. It's an important part of the kind of successful retirement, in my opinion, has a lot to do with understanding what you can spend and then kind of staying within that category. And so by moving it back to 85% probability just to test it, it does give me some range. Okay, I can go from here to here, And some people, they're at 85, and no matter what we do, that's as high as we can get it. So that's okay too, So then again, we know what we can spend at that level. But yeah.
So we have another investing question. So the pandemic showed me that certain industries are too risky to invest in. Should I be avoiding these industries for the long term?
Oh, yeah, I don't think so. You know, one of the things that happened in the pandemic is it pushed forward a lot of companies and a lot of industries, categories, whatever you want to call it, um, that are really kind of the future. So, innovative technology. I'm giving example this, DocuSign, right? So DocuSign is an ability to create documents, package them together, and send them to somebody in a secure format that they can then sign electronically. It'll automatically shove it off to the next step in the process versus the old days where we filled everything out really by hand and people had to come in. And the pandemic created, a big boon to DocuSign because, we didn't want to have face-to-face contact for quite a while, and having people sign forms, or even mailing them through the mail and then waiting for them to come back. DocuSign is, can take a few minutes. It's pretty easy. So, a company like that probably got overbought last year, just like everything else. Clean energy, really probably ran too far. Innovative technology ran probably too far. Clean energy as a whole probably ran too far. But they made great money, and I certainly wouldn't ignore, kind of what was going on in that time frame forever. It hasn't been a great year for a lot of those areas, although DocuSign actually has done okay this year. But in general, a lot of those things that did so great last year are really kind of struggling this year. And even, the most famous example are these ARC funds. This Kathy Wood had an unbelievable year last year, not having that year this year. And it's not because she's lost her touch or anything. It's just the category she's focusing on, is the future, ran up so much last year. And again, I always use this rubber band methodology, So when things go up, it's like a rubber band. There's more and more and more resistance, and it can only go so far before it kind of snaps back down. And so I think that's really what's happened in these categories. But eventually they will take off again because they are the future. These companies are really, the artificial intelligence and the robotics and all of these areas are unbelievable. And the CRISPR technology that they're using inside this, genomics pieces, that's where the vaccine came from Moderna and Pfizer, for example. These are unbelievable pieces of what will be our future. So, yeah, I would say last year was just kind of strange. You couldn't get into the basic industries because a lot of them were kind of closed down because of the pandemic. It left these other industries that could operate inside of a pandemic or were needed because of the pandemic, like DocuSign. And this year we're getting back into more broad-based things, and those things have kind of, faded a little bit. But no, they'll be back. We'll be talking about them again because the next Microsoft, the next Apple, the next Amazon, the next Google is going to come out of this group that ran last year. Watch. It might not happen for very long, but it's going to come, and that's what happened. And there's some great companies like Square and what have you that are just doing phenomenal things. And again, the pricing and PayPal, for example, pricing just got ahead of itself. That happens all the time. And then it'll settle back down and come around. I mean, Amazon had huge runs and then came back down. It's still up higher than it was then. So it's, there's some good things out there.
Yeah, and you have to remember that this is the first pandemic many, or I would say a vast majority of the world has seen in their lifetime. And
Yeah.
so pandemics don't happen very often. So being fearful of a kind of a black swan event is not a good idea. And you should understand what happens, but you shouldn't, work completely around them essentially.
Yeah, I mean, the way to deal with the black swan event. So, black swan event would be 2008 was considered a black swan event. The market dropped. S&P 500 was down a little bit over 50% in that time frame. And so, the way that you deal with those is that number one, you make sure that you have enough money in the bond market to make yourself comfortable with the possible drop. And so, if your stock portion drops 50%, and your bond portion doesn't drop or goes up or goes down a little, but stays much more stable, you can actually, there's some pretty great studies out there showing, going back to 1926, so even including the Great Depression, what mixture of stock and bond, what the return was, what the worst one year was, the best one year was. And so that can help you to visualize and say, okay, I only want 30% stock or whatever it might be. And so everybody's got a different risk tolerance there. And then you're kind of protected against those in a way because you can't see them coming. I mean, I mean, my analogy I use all the time, I think is important to understand, which is just if you can see it coming, it's not going to be a black swan event. It's always something we don't see. It was the Federal Reserve and the Treasury not bailing out Lehman Brothers. They were kind of upset because they weren't following their advice, and so they decided to let them fall. But what they didn't know was it would have caused this cascade of these credit default swaps falling apart, and the whole world would come ripping down around them. And again, it's not something it's easy to see in hindsight. Yeah, I can tell you about it, but at the time that it was happening, even the Treasury Secretary and the Federal Reserve Bernanke, they didn't see it. And so that's what a black swan event is. And so, you're walking down the street and there's, it's dark and there's a big hedge and somebody jumps out from behind the hedge. It's going to scare you. That's a black swan event. It's like, well, I didn't expect that, right? Versus the other scenario, which is where, hey, China's having problems or whatever it is, but the person's behind the hedge. And when they jump out, you're not as scared. And so that you can cause some downturns, but not these big ones that happen. And so the best way to protect against those is your stock and bond mixture and your emergency money that you have and your flexibility in your budget so that you can move down, and having less debt is a big piece of that in retirement so that you can kind of move down when you need to. Those are the best ways. Trying to guess when they're going to come. Nobody sees them coming, and you're probably not going to see them either. Is a challenge. So having the right mixture up front, I think, is the best way to go. But yeah, no, it's very fascinating, because even last year we had a 35% drop in the stock market, and it was a big event, as far as that goes. And so, how do you deal with that? And it happened very quickly. That was the fastest downturn of 35% in history of the stock market. And again, it's the first time all of us have been in a pandemic. So lots to learn there, but the basics still played out. If you had 100% stock, you suffered more than those person that had only 60% stock in their portfolio, for example. So, you know, uh, long-term stock market generally outperforms, but having the right balance for the risk is, I think, important.
So another portfolio allocation kind of question is, would you ever include like kind of alternative investment, like alternative ETFs, like or REITs in like your traditional portfolio?
Yeah, there's several different types. There's the precious metals, there's the commodities, the steel, the wood, things like that. There's real estate. Um, I guess I call real estate an alternative investment. Not really. Those are pretty standard in a lot of portfolios. Matter of fact, there's some of it even on the S&P 500. But so we've definitely used real estate in the past. Over a long period of time, we've used all kinds of different alternative investments. One of the problems has been is that they just haven't worked very well as a whole. Real estate might be the exception. It's actually doing pretty well right now. And but your precious metals, and they often more volatile. The reason you put them in a portfolio is because they sometimes go up when everything else is going down, and it actually brings down the risk of the overall portfolio, even though that one holding is actually more aggressive and can move more. But yeah, I would say it has a lot, at least for me, to do with just how poorly those have done as a group, and the volatility. And we don't have a lot of that in our portfolios at this point in time. And, buying the total stock market index from Vanguard, that's worked out pretty well. That's a really good, that's a really good holding. Buy every single stock on the U.S. stock market basically is a pretty good way to go. So, yeah, I don't have any problems with alternatives at all. I just haven't had them really work out very well in our portfolios over the years, and again, some of them are just too volatile. I don't like things that can move really fast. It's very difficult to handle, especially with the clients. All right. So that's our show for today. I want to thank everybody so much for coming. Really enjoy the show. Again, you can subscribe to the channel. You can send us your email. And if you'd like, you can schedule an appointment. If you go to our website, we have a book an appointment button, and you can just, go ahead and set up a half-hour time, to phone call or a video conference. We can talk to you about, the things that you're concerned with as far as that goes. So look forward to seeing you next week. Thank you very much.